Today I'm going to talk to you about cash flow management, another flip lesson for Business Studies 3 students. What I will talk to you about. First of all, what is cash flow management, the cash flow cycle, and now we look at the cash flow statements, the purpose and the format. When we talk about cash flow in the future, we need to talk about cash budgeting, the difference between cash flow and profit, and examples of overextension of finances and the strategies to fix them. Okay, first up, cash flow. It's the movement of cash in and out of a business. Matching cash coming in and out of the business is essential. Cash flow is the lifeblood of any business. Cash to a business is like blood to a body. Existence without cash flow can cause a business to go bankrupt, even though it may have many assets and have made some profits. Shortfalls can lead to cash flow problems and must be dealt with in a short term, otherwise the business can risk bankruptcy. Cash flows need to be monitored on a regular basis. Monthly basis would be preferable. In this instance, cash flow statements should be produced. Normally they're only produced every year, but they can be produced on a monthly basis to detail where the cash has been generated and spent. Now that information is really important. And cash budget in relation to forecasting. This is where we're trying to forecast in the future what our level of cash will be. So businesses need to prepare a cash budget to forecast any expected shortfalls or expected cash surpluses. Now let's have a look at what constitutes cash flows. Here on the diagram you can see there's a number. Cash sales, when we sell our products. When we have amounts sold on account and when they are paid back to us. Other income in terms of interest, non-operating income, for example, rent revenue. Cash outflows, we've got payments for stock, which is our biggest expense, along with wages normally, other expenses, insurance, rent, etc. And also here payments for non-operating expenses. These payments can include things like buying assets, paying back liabilities, and quite often the owners have to draw out money to live themselves, and that's called drawings. An essential part of understanding cash flow is to examine the cash flow cycle. You start with cash. We're talking about a trading business. It then buys inventories, hopefully the right inventories that people want to buy. A markup is put up on those inventories. For example, if I'm in a clothing shop, I might buy some jeans for $50, and then I put a markup on it of say 100%, which means another $50. Therefore, the sale price would be $100. Now, hopefully, I'm going to make a quick sale, so it goes to the sale stage. If it is a cash sale, then it goes straight back up to here. But in some instances, we allow our customers to buy from us on account, which means then it goes to the receivable stage. A normal business might give account for 30 days, and hopefully within 30 days that cash is paid back to us to complete the cash flow cycle. So obviously the quicker that we can make this go around, the better it is for the business. As soon as we got the cash back, we can buy more inventories and make more profit via the markup here, or pay our employees or pay back our loans or whatever we need. But the important thing is the quicker we can get this cash cycle completing, the more ability the firm has to meet its obligations. Now cash flow must be monitored. The first one I want to look at is a cash flow statement. Now that's a statement of what has happened in the past. The purpose of it is to provide liquidity about a business, so the amount of cash flowing through the business, and having information about that is extremely important. If a business is not liquid, it hasn't got enough cash to meet its commitments, i.e. the cash flow is not sufficient. The cash flow statement shows the movement of cash receipts, what we call inflows, and cash payments, outflows, over a period of time. It's very similar to a cash budget, but it shows what has happened as opposed to a cash budget which shows what will happen. Cash flow statements are divided into three categories: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now let's look at a cash flow statement in detail. As I've said, there's an operations section, an investing section, a financing section, and all those three sections are combined together in the net cash flow. Here's one such example. So at the top, cash flow from operating activities. So that information comes from the income statement. So you look at the sales, the payments for the stock or inventories, wages and salaries and other costs and that sort of thing. You can see here that the positive $600 comes in, and we have these brackets around these numbers, which is accounting speak for a negative. So you can see a positive is a positive inflow, and the negative is the cash outflow. So the net that we have from our cash flow activities, from operating activities, I beg your pardon, is 250 positive. The next section is investing activities. So we're looking at any sale of non-current assets. For example, you might have sold a machine or a piece of land or building or something like that. And when we buy non-current fixed assets, they are an outflow, again representative as minus. You can see from this example we've had a positive inflow from investing activities of 300. Now the last section is financing activities. And they include things like borrowings. You can see here that we haven't had any new borrowings raised, so that's a zero there. Changes in share capital, that involves the amount of capital put in by the owners. In this instance, 100 has come in from the shareholders to increase the cash flow. We can have outflows there as well. For example, if we have drawings by owners, which they basically take out of the business for their living expenses. So the total net increase in this case, and would have been in brackets had it been a decrease, is a total of 250 plus 300 plus 100, giving you the 650 there. Okay. In this instance, we had an opening cash balance of 340. You can see that this was a negative, and therefore the closing balance is a positive 310. Now that's what happened for that particular business over that period of time ending the 30th of June 2010. But when we deal with cash budgets, we're actually trying to do some forecasting into the future. So as I said to you before, it's similar to a cash flow statement, which shows what happened, but it is looking into the future, and therefore that can become difficult in trying to predict inflows and outflows. Very similar to the previous type of statement, but we classify it only as estimated receipts, so money coming in, and estimated payments, money going out. Now, cash budgets are vital for the information they give on the timing of payments and the receipts of income, which will be there to identify when we have excess money to invest. This is important, so we put our money to work. Commonly, if you leave money in your normal check account, your operating account, the business might only get, say, 1% or less than 1% interest. So put it to work, put it in the term deposit, buy a new asset, or do something else with it where you can get more income from it. But more commonly, we have a situation where we have a shortfall. Then managers must arrange a way to cover the shortfall in the short term. And by that I mean is that we normally, if it's a short-term deficit, then we go to the bank and arrange a thing called a bank overdraft, which basically means that the bank will allow us to go into the negative up to a certain amount, hopefully only for a short period of time. Now let's have a look at an example of a cash budget. You can see here two main categories: estimated receipts, estimated payments. We had some cash sales, some rental income, so the total income here for these particular months is as shown. Estimated payments, the cost of goods sold, wages, lease of equipment, rent, advertising, lease loan repayments, admin, electricity, and so on. You can see here drawings for the owners. Now you can see total expenses or total outlays, which is a total of these figures all the way going up to there. Okay, and what we then work out is the estimated income over expenses. This excess is calculated by taking the total income and taking away the total estimated expenses. You can see here we've got a negative figure of 2,250. That's difficult to see in this particular example, but there's the tiny little minus sign. So we initially had 10 grand in the bank, so you can see that by the end of the period the closing bank balance was 7,750, accounting for this deficit. This closing bank balance then becomes the opening bank balance for the next month, and so on. In the next month, in February, we had $37,000 worth of inflows or estimated receipts. The total estimated payments here were 34. So now we're looking at a positive 2,250, which adds to that, and we're back into the 10,000 what we started with. And similarly, we had another positive contribution expected in March. Therefore, we expect to have 14,750 at the end of March. As these are estimated figures, what businesses do, they then compare actual against estimated and do an analysis. And if the variances from any of these months is more than 10%, then they must be investigated and explained why there was such a big deviation. Okay, for example, in March we may have had an actual total income of 30,000. So we thought 40 and the expected, I beg your pardon, the actual was 30. Why was that the case? And that must be explained and the budget adjusted accordingly for the future months. Again, I come back to this diagram, looking at the inflows and outflows, and they are exactly the same in forecasting for the future as they would be for when we deal with them in the cash flow statement. Now, how can we avoid cash shortfalls? If there's a shortfall, then managers must arrange a way to cover the shortfall in the short term. They can arrange a bank overdraft. I mentioned that before. In the short to medium term, they can reduce expenses. Businesses are always looking at ways of minimising their expenses. They can try and increase income, the sales, try and reduce drawings by owners. Sometimes the owners take too much out of the business, or if it's in a really crucial stage, they may choose to decrease their drawings to a bare minimum. They can defer payment of assets, or they might even want to lease assets instead of purchasing them outright, which has a bigger impact on the cash flow in the short term. On the other side, how to deal with cash surpluses. The business must try and use cash for productive purpose. So, for example, they could invest cash or purchase some assets. A new asset could be purchased. Maybe even a business could be taken over, or we could pay back some loans. Or in another instance, we can take some money out for the owners and they can have an extra payment of drawings. When we look at cash flow, it's important to realise the difference versus profit. A business can make lots of profit, but it still experience cash flow problems, and there's a number of reasons for this. A business may have made plenty of sales and have a high level of credit sales, but if they don't get paid back straight away, all this money is out there, and it isn't coming in, and you're not completing the cash flow cycle, which can have an impact upon your cash flow in the short term. You may also be purchasing some assets that's nothing to do with income or expenses of a business, right? So that is still drawing on the cash flow. You may be obligated, or in some instances choose to pay back loans quicker. That obviously takes cash out of the cash flow cycle, and the business can still be making lots of profit, but if you pay back too many loans or too much of your loan, it can have an impact upon the cash flow, and therefore you may not be able to fulfill your short-term obligations to your suppliers, for example. The level of drawings by owners, as I mentioned before, is another way of how cash can flow out of the business, and that should also be monitored. As I mentioned, cash flow management is an extremely important part of any business, and quite often businesses get into financial difficulties, where they have overextended themselves in some way. So here's some strategies to avoid overextension and to try and maximise cash flow. Use of leasing. Instead of buying equipment outright, like cars, furniture or buildings, we can choose to lease them, and pay a normal rental amount every month. The downside of that approach is that over the whole period of time, you're going to pay lease costs and interest costs. You should avoid overdependence of finance and debt financing. As I said in another lesson, debt to equity should not exceed 100%. So it means that 50% of your assets should at least be financed by the owners. You should use forecasting tools and cash budgeting, so you know that you can predict any shortfalls that may occur. Really, this bit of advice doesn't sound like much, but quite a lot of businesses have gone by the wayside by taking two big steps. So if you expand too quickly, that usually means that you need to borrow heavily in order to do it. That means that if things go against you, or there's an economic shock, or interest rates themselves go up, interest rate payments, you're then stuck with it. It impacts upon your cash flow, and your whole strategy may come undone. Don't invest too much in stock. While high stock levels are good for customers and hence more sales, a lot of cash can be tied up in stock. A happy medium is required, especially in a smaller market like Launceston. And the biggest cost, staffing. Businesses usually incur the biggest cost in their staffing. Businesses find it more difficult to keep staff in declining economic conditions, and such need to keep staffing levels trim and perhaps outsource some of the jobs or duties, and also by substituting labour with machinery. Outsourcing means you get a certain task and get somebody outside of your business, whether it be a consultant, another service firm or whatever, to actually do that particular job for you. In terms of the machinery, in some instances we employ more technologically advanced machines, and quite commonly what that does, it takes a place of labour. So that's the end of our lesson. I hope that you've learnt all about cash flow, its management, the elements of the cash flow cycle, the purposes and elements of the cash flow statements, the cash budgets and how they're used as a sales forecasting tool, the distinction between cash flow and profit, and examples of how to avoid overextension. Hopefully that's been useful. Thanks for listening.